Hi, everyone. Lauren Culp here, publisher and CEO at CUInsight.com. And I'm bringing you a 3 questions video interview today with a really special guest. I am super excited to be joined by Jack Imes. He is the Chief Client Lending Consultant at Allied Solutions. They are a great partner of CUInsight, and we are excited to chat about something that I know is on everyone's minds right now, and that is interest rates and loan growth. So Jack, I'm going to just dive right in here. Talking about interest rates, thank you so much for joining.
Oh, my pleasure. Always good to reconnect, Lauren. Thank you.
Yes, definitely. Well, we have recently seen interest rates reach their highest level in 22 years, which is saying something. And while the Federal Reserve has slowed rate increases for this year, financial institutions and credit unions in particular still do have a long road ahead of them. So with this in mind, what do you think credit unions should really be focusing on or prioritizing going into 2024?
Well, thanks, Lauren. As summer is quickly coming to a close, credit unions across the country are in budget and strategic planning mode. And without question, the planning sessions this year are dramatically different than, prior years. As you mentioned, the biggest reason is, interest rates are at the highest levels they've been in 20 years. So over the past several years, Lauren, credit union loan growth has been exponentially strong, based on those low rates, home sales, home refinances, and even with the, computer chip and part shortages during the pandemic, auto lending has been equally strong. Now, as we talk with our credit union clients across the country, we're hearing about planning for loan growth in the single digits versus what we've seen, over the past several years, 10, 15, 20%, or even higher. So priorities and focus has changed, and from my viewpoint, fall in several categories. As credit unions continue to pursue what I call core deposit strategies for growth, right? Everybody needs liquidity. With that, the spread between interest income and interest expense, continues to narrow. These rates have gone up, but so have deposit rates. So credit unions have been, and I think will continue to have a laser focus on pricing of loans and deposits. And it's not that they didn't pay attention before, Lauren, but when rates were at all-time lows and stayed there and really didn't move, their deposit rates were essentially zero. The biggest strategy was, what loan vertical, did you want to go after to pursue for growth? The key second part of that focus and strategy is, and especially pricing, is using data. We see and we talk with clients across the country where, again, to kind of repeat myself, before it wasn't quite so hard to price loans and deposits, but now the competition is fierce for loans and deposits. And we see folks, they've been collecting all this data for many years, and we see them, and they should be using that to drive some of these pricing decisions. So with that, I also want to mention that one of the key drivers, the key differentiating points for credit unions to tell their story is how strong they are. Nationally, the capital levels for credit unions are well in excess of the regulatory requirement. Delinquencies, while rising for credit unions, are still at very low levels when compared to banks. And this is based on that conservative nature of credit unions to serve their members, but also do so in a conservative manner. And so they're going up, Lauren, but they've started at such low levels. And the same is true with charge-offs, again, rising slowly, but again, they started so low. So the story I like to tell, and where I want folks to prioritize, is to tell the story about what I say credit unions have built fortress balance sheets to weather this economy. They generally have not taken on a lot of the risks that some that people would associate with banks. And a priority has been and always will continue to be look back towards the membership and their members and their communities. Finally, a continuation of that core deposit strategy, it'll be equally critically important to have a measured and focused loan growth strategy as well.
You mentioned loan growth, and that is going to be vital. I think there's no doubt about it. But to your point earlier, a little tough in this environment. What are some of the key drivers that you would say will really perpetuate growth in a high interest rate environment?
So it won't come as a surprise to you, Lauren, that I see one of the key drivers for credit unions in this, wonky economy, as I like to call it, to focus back inwardly towards their existing membership for growth, helping their members through this, these uncharted territories with these high rates. One example of that, Lauren, is credit card balances nationally stand at $1 trillion. That's an all-time high. So where appropriate, I see credit unions standing ready to assist their members through some of these challenging times. As an example, consolidating debt and terming that out over time. Credit unions do that better than any other financial institutions. And separately, and in many ways, what I always call the secret sauce for credit unions is their field of membership. Reaching out during this economic period and expanding to new parts of their field of membership will be critical to growth. And using technology for that growth will be critical. And what I like to call the good old days, in many ways, you'd build a branch and it was under that build it and they will come strategy. No longer is the same. Technology will be the piece of the puzzle to bridge that gap for that growth over the next few years.
That is so true. And I think as credit unions, we've seen, we've had good member service for so long, but these days, good member service equates to a really good digital experience. And so I'm curious from your perspective, well, what part do you see technology playing in that lending landscape?
Well, the timing's perfect, Lauren. Nationally, because of inflation, we've seen in my industry, in the credit union industry, what we call non-interest expense, which is things like salaries and general expenses. They've climbed for all companies, including credit unions. So they've just exploded over time. Everything costs more, right? For credit unions to some extent, so far, the interest income has helped offset that rise in expenses because, as you might recall, as rates took off, a lot of banks exited, like as an example, the auto lending market. But the credit union movement doubled down over that 12 to 18-month period and really loaded up their balance sheets with a lot of really good loans. So that interest income has helped offset that non-interest expenses as inflation has driven up the cost. But as lending has slowed down, we've seen credit unions looking towards technology to become more efficient. Being more efficient helps the bottom line to control that non-interest expense. And, specifically, I'm talking about the cost of human capital. As you know, many of the fintech and AI technology platforms require less human involvement. RPA, robotic process automation, can actually help control expenses over time. And in no way am I suggesting that technology will replace humans. In fact, quite frankly, in the credit union movement, I see it in a totally different light. What technology is doing is actually freeing up time for the credit union team members to do what they're very, very good at, which is helping members and giving them that high touch, high feel experience that credit unions have shown for many, many years to be exceptional at. And so one byproduct of having lending slowed down a little bit is that hopefully there'll be more time to implement some of these technology solutions. So not only will technology help credit unions become more efficient, help with expenses, but it will also help serve their members better, Lauren, and also control expenses. But that technology will also help credit unions compete with fintechs, especially to garner some of the younger members, the Gen Y, the Gen Z, the Gen X, who are used to using that technology. So it comes at a great time. It can help them control expenses, and it'll help bridge that gap to garner some younger members.
Well, Jack, you shared so many good insights for credit unions on what to do in a really high interest rate environment, how to continue to grow loans, and to your point, how to really leverage this moment in time to enhance our technology so that we can continue to be that preferred lending partner for consumers for many, many years to come. As we wrap up the conversation today, do you have any final thoughts for our audience or final asks of our listeners today?
Well, again, thank you, Lauren, for having me again. And I would say to fall back on what I talked about before, and the credit union movement has built this over time. There's a lot of uncertainty out there. Interest rates are as high as they've been from 20 years ago. And there's a lot of uncertainty with inflation. Is there going to be a recession? Is the Fed going to raise rates again? What's going to happen? And so I'm going to lean back on what I talked about before, where the credit union movement has really done a phenomenal job of building these fortress balance sheets. Folks are worried about the safety and soundness of financial institutions. And I don't think they need to worry about that with credit unions, because I look at balance sheets and income statements every day for credit unions, and they've done a tremendous job, controlling delinquencies and charge-offs, being conservative in nature, building capital to weather the storm of what we're talking about right now. And so I think it's a great time for the credit unions to tell their communities, we are strong and we will be here to help you weather this, and we'll come out on the other side together.
Absolutely. Well, what a great way to wrap up the conversation today. We are going to link to contact information for Jack and his team at Allied Solutions. So anyone who's interested in reaching out, learning more about what they can offer credit unions, we will have that right in the post here. Jack, thank you so much for spending some time with me today. So great getting to catch up.
Oh, always great talking with you, Lauren. Thank you so much.
Yeah, thank you. And thank you to all of our listeners for tuning in today. And we will be back again next time.